Hi, my name is George Dagnino. I'm the editor of the Peter Dac portfolio since 1977. What I would like to talk to you today is about commodities in bond yields and what drives them. This is the leading indicator of the developed economies. It's published by the OECD. This is the Great Recession of 2009. And what it shows is three basic slowdowns. One 11, 12, another one 14, 16, and the one that started in 2018. I talked in previous videos about these two slowdowns that were associated with the same patterns. And what this indicator is showing is that the same thing is going to happen from 2018 on. The most important trend, which is the subject of today's video, is that when the economy slows down, the global economy, and by the way, the same thing happens to the US economy, like in 2014-16, commodities decline. And because of the weakness of the economy, also demand for money declines, and therefore bond yields also head lower. Let me show you. Yes, this is a messy chart, but it's done on purpose. What this chart is showing is copper prices, crude oil prices, 10-year Treasury bond yields, and lumber. There is no question that this trends, all these prices, if you wish, they're all coming down during the slowdown of 14-15. They rose because of the strengthening economy again after 2016. And look at what's happening now. They're all coming down. I think what is important of this chart is that sometimes you hear that lumber is associated to building and construction, yields is connected to the Federal Reserve and tampering and raising interest rates, lowering interest rates. Crude oil is because of the Arabia, what happens in the Middle East, or what happens in the Permian Basin. This is all nonsense. The bottom line is that all these prices come down when the economy slows down, they rise when the economy strengthens, and then decline again when the economy slows down. By the way, I didn't put the change in earnings for the S&P 500. But if you superimpose to this chart the change in earnings, what you see is earnings slow down during 14-15, which happens, by the way, the market also did not act well. The market earnings improved, accelerated again from 16 to 17. And guess what? Earnings now are slowing down. The market is not performing well. So the bottom line is that the global business cycle and the US business cycle, which are closely connected, drives asset prices. Make no mistakes about it. This is a reminder that I wrote 3 books. The first one is Profiting in Bull or Bear Market, that has been commissioned by McGraw-Hill Education, is available in Mandarin in China and Taiwan. These 2 books are a simpler version of the first one, much simpler version, and they show some easy to follow model portfolios with very easy to follow rules, and they have outperformed the market by a substantial amount. Thought you might be interested in looking at them. Okay, thank you very much for listening. So long.